Hey everyone, welcome back to Corporate Dakota Today. Greenwich LifeSciences Incorporated just filed its 2025 Form 10. Kay and I am seeing some very interesting things in their financials and risk factors. Quick note, this is not financial advice, just my take on public filings for educational purposes. This company is betting big on a new breast cancer treatment, and while they are burning through cash, they are also making some significant moves to keep it going. Alright, let us dive into Greenwich LifeSciences Incorporated's 2025 annual report, which is a really important document for understanding where a public company stands. So first up, the company is focused on a phase 3 clinical trial called Flamingo Negative 01 for a breast cancer immunotherapy, known as GLSI Negative 100. It aims to prevent breast cancer from coming back after surgery. Now, for the numbers, the company reported a net loss of about $19.4 million for 2025, which is a bit higher than the $17.4 million loss in 2024. A big chunk of that loss comes from research and development costs, which actually went up by about 11% to over $17 million in 2025. This is mainly because they are pouring more money into that phase 3 trial. Their general and administrative costs also saw a small increase, going from about $2.1 million to $2.2 million. On the balance sheet, they had about $6.2 million in cash at the end of 2025. This is an improvement from about $4.1 million at the end of 2024. How did they boost their cash? They raised nearly $12 million from selling stock through something called an at-the-market or ATM program, and also from exercise warrants, so they are actively raising funds. Specifically in 2025, they sold over 1.1 million shares at an average price of about $10.85 per S-Hair, bringing in over $11.8 million. After fees, this shows they are still leveraging the equity markets to fund their operations. Back in 2024, they also raised cash through a private placement, bringing in about $2.5 million. Now, this is critical. The auditors flagged a big issue. They said the company has had recurring losses, and this raises substantial doubt about its ability to continue as a going concern. This means they are not sure if the company can stay in business for the next year without additional funding. It is like saying a car is running low on gas and might not make it to the next town. And there is more. The company had to restate its financial statements. This often means they found errors in their previous reporting back in 2024. They realized they had misclassified about $1.6 million in expenses related to their clinical trial partners. Especially in Europe, it seems like delays in receiving invoices from these partners caused them to miss recording these costs properly in the prior year. This also means that some expenses they recorded in early 2025 were actually from 2024. This kind of accounting revision and delay in invoice processing can sometimes signal internal control weaknesses. For instance, their 2024 research and development costs had to be adjusted upwards by over $2.5 million. And their general and administrative expenses for 2024 were actually lower by about $900,000 than originally reported. They also reclassified some employee and consultant compensation between R&D and GIA, which did not change the total operating expenses, but shows them trying to better align costs with activities. Let us look at the risks Greenwich LifeSciences is facing. They explicitly state they need a lot more money to finish developing their product, and if they cannot get it, they might have to slow down or stop their work entirely. This is a huge risk for any clinical stage biopharma company. Another major risk is that their experimental drug might not be safe or effective. The clinical trials are crucial, and if they show bad side effects or do not work as planned, it could stop the whole project. They also depend on third parties to make their drug, and if those manufacturers have problems or cannot produce enough, they could face supply shortages and higher costs. And of course, competition is a big factor. There are other companies working on similar treatments, and if they get there first or have a better product, it could hurt Greenwich LifeSciences' chances. Looking at the stock itself, it has been quite volatile, with a 52-week range from about 7.78 to 34.1. $0 recently trading around $22.25. Major institutions like BlackRock and Vanguard hold significant stakes, but they are still relatively small percentages of the company. The auditor for this report is Malone Bailey LLP. They have served as the company's auditor since 2025. Looking at the bottom line for 2025, the net loss was around $19.4 million. This translates to a loss of about $1.43 per S-Hair for 2025, which is worse than the $1.34 loss per S-Hair in 2024. Their current liabilities are almost $6 million, which is significantly higher than their cash balance. Now, this company is really in a race against time and money. They are making progress with their clinical trial, but the increasing losses and the auditors' doubt about their ability to keep going are serious red flags. The accounting restatement just adds another layer of caution. It is a high risk high. Reward situation typical for biotech, but investors need to be very aware of the substantial financing needs and the potential for trial failures or regulatory hurdles. The focus must remain on the phase the third trial's success and their ability to secure that much. Needed funding, and the research tools I actually use are linked in the description. They help keep this channel going. That is my Take Stay Decoded if you appreciate getting straight insights from corporate documents. Make sure you are subscribed, like this video, and check out the Discord linked in the description below.